Hey, I'm Abe, and today we're going to talk about capital gains, which are basically the taxes that you pay on your investments. Simply put, the capital gain on your investment is the difference between what you sold it for and what you bought it for. That delta, or that difference in value, is what you will be taxed on. You can have capital gains, you can have capital losses. Obviously, if you bought something that lost value and then you sold it, that's a capital loss. And your capital gains minus your capital losses equal your net capital gain. On investing sites, when you look at your holdings or your positions and balances of all of the things that you're invested in, you will see a column for unrealized gains. And what that is, when compared to realized gains, is if you're holding a stock or a bond or a mutual fund and its value has changed, but you have not sold that asset yet, that is an unrealized gain or loss. Whereas the moment you sell it, it becomes realized. You can have unrealized gains and losses all over the place, and it has no bearing on your taxes whatsoever. Nothing actually takes effect or will impact you until you sell that asset. The next really important part of capital gains is the difference between short-term versus long-term capital gains. Short-term capital gains are the realized gains that you received on an asset that you held for less than 1 year. If you hold it for longer than 1 year, it is considered a long-term capital gain. And why does that matter? It matters because short-term capital gains are taxed at your income tax rate, whereas long-term capital gains are taxed at its own much smaller tax rate. Long-term capital gains are taxed at 0%, 15%, or 20%. Depending on your income bracket. If you are filing as a single taxpayer and you make less than $39,000, you will pay 0% long-term capital gains tax. If you make somewhere between $39,000 and $434,000, you will pay 15%, and that's where the vast majority of people will fall. You will pay 15% on your capital gains, and if you make more than $434,000, you will pay 20% on your long-term capital gains. If you're filing married, the bottom bracket is 0 to 78 or 79, somewhere in there. It's 78.75, but I'm going to round for the sake of our conversation here. So 0 to $79,000, you will pay 0% on your long-term capital gains tax. $79,000 to $489,000 when you're filing married, that you'll end up paying 15% capital gains tax on. If you make more than $489,000 as a joint or a married couple, then you will be paying 20%. An additional proviso on top of that, something called investment income tax, and that may apply if your modified adjusted gross income is greater than $200,000 per year as a single filer or $250,000 as a married filer. And what that additional percentage is an additional 3.8%. So if after all of your deductions, your income still, as far as the IRS is concerned, is more than $200,000 as a single person or more than $250,000 as a married couple, then you will have to add an additional 3.8% to that 0, 15, or 20% long-term capital gains. So the first big takeaway is that there are short-term capital gains and long-term capital gains. And you want to make sure, if possible, that you're really only subjecting yourself to long-term capital gains. Where would you see these taxes coming into play? They come into play when you're moving your assets around in non-retirement accounts. So the last week or two, we've talked about retirement accounts like the Roth IRA, the 401k, and the traditional IRA. Inside those accounts, all of the activities that you take are tax-free until you withdraw from the account itself. Generally speaking, though, in regular brokerage accounts and forms that are outside your general retirement accounts, you will be charged tax whenever you sell an asset. So if you have a stock, it's worth, I don't know, I'm going to use really round numbers here and big numbers just so that it's easy to do the math. But let's say you have a stock, it's $1,000. Over 1 year, it raises 10%. So now it's worth $1,100. You sell it, you're going to pay the 15% capital gains tax on that long-term capital gains because you waited more than a year on the difference. So the $1,100 is where you sold it, the $1,000 is where you bought it, the difference is $100. So you get taxed on that $100. and you're going to be taxed, let's say, at 15%. So you will owe 15% in taxes. Your brokerage account will not hold that out like your paycheck does for those taxes. You will have to plan for that and then pay for it when you go to file your taxes in April or March or whenever it is that you file your taxes. So keep that in mind. Someone else is not collecting tax on your investments for you. You will have to keep track of that yourself. When you are each year or each month, if you are reassessing where your investments are, you need to keep in mind that when you sell any of the assets outside of your retirement accounts, you're going to be paying taxes on it. It adds a layer of strategy to rebalancing and reallocating your investments. Another thing to keep in mind is that your capital losses will counterbalance your capital gains. So if you made $100 on the sale of one asset, but you lost $100 on the sale of another asset, those will balance each other out and you won't owe any taxes at all because your $100 in gains was offset by your $100 in losses. So in an attempt to reduce your overall capital gains tax and liability at the end of the year, during the year, you can plan for that by seeing assets that you might want to unload. And when they're low and when they've, say, taken a loss, you can take that loss and offset what gains you might have found in another asset and make it so that your tax liability is very low, if not non-existent. So what assets qualify as capital assets? And that would be treated in this way. Stocks, bonds, mutual funds, exchange traded funds, most of the commonly traded items when you're investing and active in the market. Other items that are handled similarly but not exactly the same are collections and art. So jewelry, coin collections, your home, as an example, is a different thing. Collectibles are generally taxed at 28%. Some of the other items, like your house, have very specific rules for if your house's value has appreciated over a certain amount, then you only get taxed over a certain amount. And so that's its own video, and we'll get into that at some point in probably the distant future. But for now, realize that primarily what we're talking about when we're talking about capital gains, short-term, long-term, we're talking about your investments in stocks, bonds, mutual funds, and ETFs. The other items like jewelry and your coin collections or your stamp collections or artwork, those things are taxed at 28%. What won't be included in capital gains? Your business inventory, for example, is not a capital gain. Your depreciable business property, so whether it's your office space that you bought and you're paying, your mortgage on, the machinery that you use at your company, whether you have a printing press or a mold or something else, it will lose its value over time. And this is not something you will get capital gains on. Copyrights, artwork you've created as opposed to artwork that you bought, patents, secret formulas, things like that. Those are all items that are not included in capital gains. Now, there are some tables in the links that I've provided down in the video description below. If you want to go and plug in some numbers for yourself, they have calculators there as well. You can figure out what you think your capital gains taxes will be based on your income level, based on your filing status, and the amount of money that you've made or lost on selling these assets. So that's capital gains. The two major takeaways are, one, that there are short-term and long-term capital gains, which means that you will pay more tax if you decide to sell it in the short term than you would if you waited for a longer period of time, say more than a year. Secondly, this tax rate is far lower than your income tax rate. When you think about how wealthy people continue to make a ton of money and are taxed significantly less than everybody else, it's not because the IRS, or at least it's not primarily because the IRS is just cutting them a deal or that their accountants are able to find all kinds of deductions that they're able to take that other people wouldn't know about or be able to take advantage of. It's not usually that. A lot of it is that the vast majority of their income is coming from investments. And so as a result, their investments, they only are going to get taxed at most like 23.8%, whereas the top tax bracket is something like 37%, maybe even higher. This is how wealthy people pay lower taxes on a much higher income. They are reporting a lot of their income, and they are gaining and getting a lot of their income from investments, from buying something and selling it for much higher later on down the road. And maybe that's 30 years down the road and so they're able to really reap the reward of those long-term capital gains. But that's how they're doing it. Hit me up in the comments with whatever questions you have or experiences that you've had where you incurred taxes on sales of assets that you weren't expecting. And next week, we will talk a little bit more about how to think about which of these retirement accounts, which of these brokerage options, and when you're saving money, where to start putting them first, and then how to prioritize where your money is going. I know we had originally talked about doing it today, but I thought I had talked about capital gains and I wasn't sure everybody knew what they were. So I thought I'd make a quick video about that first, and then next week we'll get into the accounts and the prioritization. Thanks for watching, and I'll catch you in the next video.